In your money this week, the Fed met and left interest rates unchanged, which led bond yields to increase. The economy in the second quarter grew below economists' expectations, and a market rotation benefiting investors who diversified away from mega cap tech is underway. I discussed this and more without Andrew this week, who tells me he has a family commitment. I think he's at the Library of Congress personally, researching his presidents who haven't gotten a bar fight or a tavern scuffle theory of leadership as to why the war with Iran is not going as well as it could. For those of you like my wife who don't like just looking at my face on these videos, rest assured I'm going to have some charts to ease your pain. Please like the video, subscribe to the channel, check out the Boston Advisor blog where I expand on this video to share the best personal finance reads from the past week and why they matter, book recommendations, and timely blog posts. So as I said, the Fed met this week and left rates unchanged, which wasn't a surprise. Markets had priced in about a 30% chance of a hike. But what was interesting is that 3 of the 12 voters actually wanted to raise rates. John Authors pointed out at Bloomberg that this is rare. It's only the sixth time in the last 30 years that at least 3 Fed voters have dissented, sharing that in this chart here, the number of FOMC dissents against action. 3, only the sixth time in the last 30 years that that happens. That tells you something about how unsettled the inflation picture still is. Inflation remains above the Fed's 2% target. The war is putting upward pressure on oil. Tariffs are being reintroduced on almost all American imports, and despite the Fed holding steady this week, markets are still expecting a hike later this year and another in early 2027. Market expectations have been wrong before, and the data can change quickly, but to make the case that hikes won't be needed, you'd have to assume inflation is mostly war-related, tariffs won't meaningfully raise prices, and the economy or labor market will soften enough to take the pressure off the Fed. I don't know which direction it's going. Maybe that happens, but right now the economy still looks decent and the labor market is holding up, which brings us to the 10-year Treasury yield, which hit a recent high of 4.7%. That move could simply reflect higher oil prices and the conflict, but it could also reflect something bigger. Bond investors worrying that inflation remains sticky and the Fed may have to hike again. The economic data adds to that tension. The economy grew at a 1.5% annualized rate in the second quarter, a little below expectations, but the underlying details were better. Consumer spending and business investment were both strong. The other big story this week is market breadth. The equal weight S&P 500 hit another all-time high and is outperforming the regular S&P 500 year to date, which you can see here on this chart. While we're at it, it's not just that the equal weight is outperforming the S&P 500. Looking at these indices using ETFs, so the S&P 500 SPY up 8.2%, the equal weight ETF up 10.9%, but Russell 2000 small caps up 16, emerging markets up 13.3, developed international 8.11%. But back to the equal weight, it matters because the equal weight version of the S&P gives every company the same weight, while the traditional S&P 500 is dominated by the largest companies. Right now, the top 10 names make up about 36% of the index, and as you can see, NVIDIA, Apple, Microsoft, Amazon, Alphabet, Broadcom, Micron, Meta, Tesla, those names are heavily tilted toward technology. We've spent a lot of time talking about AI, and rightly so. AI is still the pig in the python for today's stock market and economy. The conversation's not going away, especially with questions around circular financing, massive capital spending, and Wall Street starting to separate AI winners and losers. And I'm going to share a couple of those articles in my weekly reads below. But this week is also a reminder that the market may be broadening beyond AI, at least for now. Some of the big tech names are struggling while the average stock is doing well. As a stock picking friend of mine put it, the stuff that's been ignored for so long is finally doing better. Be sure to check out the Your Money This Week blog post, which besides sharing this video, also shares the 2 articles I referenced from Bloomberg about picking AI winners and losers through elevated credit default swaps and a guide to the circular deals underpinning the AI boom. A Morningstar article highlighting 4 ways portfolio diversification paid off this year, how to supersize your retirement account, and how asset location can boost after-tax returns by Vanguard, plus an article for business owners on how to protect generational wealth after selling your business. Thank you for listening. Please like the video, subscribe to the channel, and let others know about it so we can find them too. Thank you.